Hi everyone, it's Glenn from 21st Century Group and 21st Century Property Constructions and Investments and Boutique Properties. As you know that all the times for the last 25, 26 years, I've focused and my concentration has always been in Queensland. I've got all my licenses over there and I've actually not looked at any other market, especially the Sydney market. And the reason I have not looked into the Sydney market is because of the entry level, the dollar entry level into the Sydney market. And as you all know, is quite high. A very good friend of mine and I, his name is Mel Champa, and I'm sure I've known Mel for a long time. And I'm sure some of you all would have even used Mel's services in the past. We've come up with a way where you could get into the Sydney market at a very reasonable dollar amount, okay? What I'm going to do is I'm going to ask Mel to explain to you how this all works. And if you are interested in knowing a little bit more about it, just ring me or email me and we can have a bit of a chat. I'm going to introduce you to Mel Champa. Say hi, Mel.
Hi, everyone.
Well, take it away.
All right, thanks for that, Glenn. So as you can see from the title of our presentation, this is all about having a share in a property development in Sydney, New South Wales. So very exciting. I guess this is all based on the principle of strength in numbers. We've all heard that term, and it's all about the fact that you can achieve much more as a group than you can on your own. And in relation to the property market, that's especially true. As anyone who knows the Sydney property market will tell you, the more valuable, the more expensive a property is, the better it performs in terms of capital growth, the more it delivers to you. But of course, you've got that problem of how do you access it? It's so expensive, but certainly the proof is there. You know, you invest in a property that's worth $1 million. In over 10 years, it performs so much better and delivers you so much more than a property that was only $200,000. So that principle of strength in numbers, being able to buy into something more expensive, certainly shows in the Sydney market. And the second point leading off that principle of strength in numbers is having the capital to unlock the value of a property. Whether it's because a property's you've undercapitalized on a property, or whether it simply has the potential to be something more, you need capital to unlock that value. And that again is where if you come together in a group with your critical mass, you can really unlock that potential. So if we look at the way this has been done in the past, or is being done on a bigger scale, all we have to look at is managed property funds. You can invest as an investor in a managed property fund, and that can get you access to a property development, commercial properties, industrial properties, residential properties. They're all available. But of course, the way these funds are structured is such that they're highly regulated, and regulation means inefficiency. It means administrative expense. The cost of regulation is very high. Prospectuses are required. You've got entire management teams, admin teams, on top of the cost of the development itself. And the result, the punchline of those extra costs is that you have a very low return left for the actual investor. So by the time your money goes in, it contributes towards this development, but because of all those admin costs, there's very little left in terms of a return. So what's the alternative? Well, what we've come up with is a way for you as an investor to more directly invest in a property development so that we cut out those admin expenses. It's all about cutting out those regulatory expenses. And it's all about the directness, okay? The fact that there are no layers between you as the investor and the property development, as is the case with the managed property fund. So in terms of the investment structure and the way it works, is that it happens through a company. The company is created for the sole purpose of doing this development and carrying out this project. It's a high worth property, which has this, as I mentioned before, this potential to be so much more. Okay, and as an investor, you actually become a shareholder. You become an owner, a part owner of the project. So you have that direct control as a part owner in the project. Basically, as a shareholder in the company that owns this property that's now being developed, you then share in the sale of the property. The developed property is sold. All of the net proceeds are distributed to the shareholders in accordance with their shareholding. At the end of it all, the company's then shut down. So it's clean. It's set up for the sole purpose of the project. It carries out that purpose. Once that purpose is complete, the company is shut down. Your shareholding is no longer, and there are no longer any ties, any obligations, any liabilities associated with that company. So hopefully I've explained how it works. It's very simple, but I thought I'd kick on and show you an upcoming project which is on our books. It's on the horizon. It's a property at Austral. Okay, it's a 2.67 hectare property, and it has the potential to be divided into 50 lots. Now, we are keeping this project as a bit of a unique project in that you could do more with a property that size. The zoning allows you to do more, but we're turning it into a fairly unique and desirable prospect for the end buyers, in that each lot will be 450 square metres. These days, if you look at these new developments, the new lots are usually between 300 to 350 square metres. These will be bigger and they'll be more appealing. Okay, so if you have a look at this project, after dedicating the required land to roads, parkland, we still have enough left over for these 50 lots. Sorry, I think I've gone. Okay. Okay, so looking at the cost structure of a project like this, there's the land cost. Okay, we're looking at about $7.26 million. Stamp duty is another $435,000. And then there are your costs. You can see the list of professionals there that you'd need to get the project underway. The developer who is actually running the project receives a flat fee of $1 million for putting it all together, executing it, delivering it. And then you've got council fees, and then you've got your infrastructure costs. So you put in all the services, sewer, water, electricity, etc. The roads, all of that needs to be done as part of the project. So all that's being factored in. So then we look at the selling costs, and we look at what other properties in the area have been selling for, both as vacant land and as house and land packages, because this would be a mix. Predominantly vacant land, we'd be selling them as vacant land predominantly because they're easier to sell that way, but there'd also be some in there as house and land packages. And you can see there what sort of sales have been achieved. And on those total combined sales, you know, at a selling fee of about 1.1%, what your marketing and sales fees would be. Okay, so looking on, if we sort of summarize all of those costs, we're looking at a total project cost of around just over $11 million. And then the time, when we look at the time needed to complete all that, you know, we're looking at around about 2 years from start to finish. We would be selling off the plan right up front, So there's no waiting in terms of marketing. As soon as the land's secured, we start marketing the sales. And that way we secure our sales as early as we can. So there's a detail of the timeline. You know, we'd be targeting bulk of the lots being sold within about a year. So let's talk about the return on your investment. It's all based on how much you invest. Your investment will determine how many shares you're allocated in the project company. I've given you there an example of a $100,000 investment, which would give you an allocation of 33 shares out of a total of 10,000. And if you multiply that by the profit that would be delivered from the sale of those 50 lots, you'd be looking at a return on $100,000 of just over $30,000 there. So over a 2-year period, you're looking at a return of almost 32%. Now, I've got a little rider there at the bottom, as you can see. For investments of $250,000 or higher, the investor does receive a premium on top of their profit share of 5%. That's 5% of the profit. 5% of your investment. So on top of that $31,000, if it was applicable to the 100,000, it isn't. It's applicable to 250,000. But just to keep it simple, applying it to that $100,000 investment, there would be an extra return on top of that $31,800 of $5,000. So it just makes the investment that much more attractive if you do invest a little bit more. Now, how to get started? It's quite simple. You just email Glenn, just let him know you're interested. Glenn will then make contact with you to talk about the project a little bit more and your options for sourcing the funds, how to access the funding, and how much you want to invest. Once he has those details, you'll receive a project pack. That project pack will contain everything you need to kick it all off to secure your commitment to the project, and then off we go. So that's about it from me, Glenn. I don't know if you want to add anything else, but it's pretty simple. The structure's simple. Just a matter of expressing your interest.
Thanks, Mel. As Mel said, the project it's quite simple. It's straightforward. And if you're interested, just send me an email. We can have a bit of a chat, and we'll send something off in the mail for you as well, so that you could take a look at it and study it a little bit more, and one step at a time. So once again, lovely talking to all of you. Hope to hear from you soon. Thanks. Bye.
Thanks, guys.